Welcome to the Value Investor TV podcast. My name is Becco and my partner, Hari.
Hello.
Welcome to the podcast. Today, we will talk about a heated topic that's been around the news for a long time now, the failed IPO of WeWork. And as a result of that, people have been scrutinizing WeWork and its governance. What has been Adam Neumann been up to, and SoftBank and JP Morgan's now involved? What the hell is going on with this company? We will talk about that in detail and our take on this whole fiasco. Hari, give us a quick disclaimer before we start, please.
Yeah, this is a Value Investor TV podcast. It's the podcast that helps you understand how value investing works. We are not financial advisors and don't know your financial situation, so please consult with an advisor before making any decisions. Excellent.
This episode is similar to the one that we did before, 82, episode 82, just a prior episode where we are talking about a specific articles and just talking about our thoughts on them. And this is something that we've done very frequently when I was working with Hari at the same company. Now that we work for a different company, I thought this was a good opportunity to do that. Hari and myself, and an opportunity to open up our dialogue to all of our listeners so that we can share our thoughts about these things. For example, WeWork. In the previous episode, we talked about Berkshire Hathaway, and then also the fact that companies are splitting chairman and CEO roles when times get tough. Okay, so in this episode, a lot of juicy details with WeWork, with Adam Neumann, this charismatic CEO and founder, and the whole fiasco that's been unfolding for the past few weeks. But what's interesting is, Hari, actually, let me just start with this Wall Street Journal article: "The Fall of WeWork, how a startup darling came unglued." This was published. This was published in October 24th, and I think this article kind of nicely summarizes what happened. The fall of WeWork. And the subtitle, "The Cliff Dive Has Little Precedent Even in the Boom and Bust World of Venture Capital." It's pretty astounding, right? I mean,
yeah, it's pretty hard. It's pretty hard to imagine, a company that was losing this much money. Like I was really hoping that they would go public, that we could actually do a full podcast on it, just for the laughs, like of reading their IPO prospectus and their annual report. Because I mean, this is a business that, for those of you who don't know, they will lease office space from another, like a commercial real estate, a building, basically, remodel it and then rent it out on short-term leases. And the idea is that, there are other companies that do this. Regis is one of them. And, typically commercial real estate is 5-year leases, right? It's 5-year leases. If you leave the building, you have to sublease it or pay out, the lease. And so WeWork was essentially saying, and the reason that the buildings ask for 5-year leases is you don't want a lot of turnover. It's very expensive to find a new person. And you want the cost of their remodel to be amortized over the 5-year period. So WeWork, I think, is the largest tenant in New York City, and had this just enormous amount of office space, and they were renting places in China and Hong Kong and all over the world. And really, there's no benefit. If I live in Houston, Texas, there's no benefit for me to have a WeWork subscription in China, right? Like, I don't get any benefit if I leave, unless I travel to China and need to work somewhere, right? It's a fairly fleeting thing to begin with. But on top of that, if you're a startup, most startups fail within the first 3 to 6 months. So WeWork is having to constantly find people to come into their office space, right? So, and it's clear from their just looking at their P&L, they're losing money hand over fist, right?
Yeah.
5,
just
6, yeah, go ahead.
Go ahead.
Go ahead and tell them how much they're losing.
Yeah, this is in the article, the Wall Street Journal article we were talking about. in the most recent quarter in Q2 2019, they lost $500 million. This is net loss. And the most they've lost in a single quarter is $589 million, and that was Q4 2018. And not a single quarter did they actually make any money. The closest they've gotten to is negative 25 million. That was in Q2 2017. Just some color for you guys.
Yeah, so I mean, you want to think about how ridiculous that is, right? This is a company that's trying to raise money, which they got from SoftBank. SoftBank valued them at $47 billion. There was a down round afterwards, which valued them at like less than 30. And then the IPO failed because people were, short sellers, I imagine, were just drooling to, short this thing out of existence. And then they canceled the IPO and had to go get a private debt funding for valuing the company at around $8 billion. And now SoftBank owns about 80% of the company. Now, why SoftBank would even touch this thing, I don't understand. This guy is just crazy because he's also invested in Uber and all of these other money-losing businesses.
Yeah, we're talking about Masa-san. He's the founder of SoftBank.
Yeah. So, and he is raising money from a vision fund, is what he called it, $100 billion vision fund, raising money from Saudis and other groups. So anyway, I think one of the things that you and I talk about a lot is flawed business models, right? And how just because something is new or they use the word tech doesn't mean that it actually, if you make software, right, you can have a very high return on equity because the cost of making another version of the software or, another copy of the software is basically free, right? There is no software benefit for WeWork, right? There is no software benefit for Uber or Lyft.
Ari,
yeah,
can you hear me?
Yeah, I can hear you. Can you hear me?
Yep.
All right, let me get this set up again. You still there?
Yep. Can you hear me?
Yeah, I have no video. Okay, there you are.
Okay.
All right. Okay.
So you were talking about the software benefit of software, Ari?
Yeah, so the benefits of software are pretty obvious, right? You can print another copy of a thing for essentially nothing. But imagine, what they are pitching in these Silicon Valley meeting rooms is Uber and Lyft. It's a software application to get, a car ride. Well, the car ride itself has expense, right? And as we saw when we talked about Lyft, a lot of it is actually the insurance, of managing the insurance cost for running a commercial fleet of vehicles, right? And most insurance companies don't want to take on that burden, and so Lyft and Uber are self-insuring that kind of stuff. So, you're running into a lot of non-software things when running these businesses. WeWork is a hard asset business, right? And there is no benefit of software in this case. And the Adam Neumann, who is the CEO, was saying things like WeWork's mission is to elevate the world's consciousness and, stuff like that. And Lyft had the same kind of similar, BS sounding, words that they put into their IPO prospectus. Mm-hmm. Like they're going to take over 95% of transportation. And I'm like, that doesn't make any sense, right?
Yeah. I think if I could just add one thing there is, I think a lot of these companies nowadays are craving for the sort of valuation that you get when you're a tech company, right?
Yeah.
When you claim yourself as a tech company, you get the benefit of, for whatever reason, you get the benefit of just crazy, insane valuation. So even though you have these other tech adjacent businesses like WeWork, for example, they have to spin it in a way that, oh, it's a tech company, so therefore you get bigger valuation, when in fact it really is, it's totally not the case.
Yeah, and I think the thing is that we have seen these kind of scams with other companies. Theranos, had no business. They didn't actually make a real product. WeWork has a real product, but they're giving it away. Essentially, I don't know what it would cost, but I've looked at a WeWork office space, and they charge like $250 or $300 a month for an office. And if I were a contractor or something like that, I want to get out of the house, that may make sense for me to make that. But really, they need to be charging closer to $500 a month. I'm just using these numbers as an example. It doesn't make sense for, $500 is going to make a lot of people walk away from it, right? $250, it makes a little more sense. And the same thing is happening with Uber and Lyft, right? A ride that should cost $20, they're charging you $10 for. Mm-hmm. And so they're not covering their costs with it.
Yeah. Well, one thing about Uber that I want to mention, living in San Francisco now, they're kind of hiking up the price.
Yeah.
Now they've become a public company. They need to learn how to make money. So they're kind of hiking up the price, and people are screaming and saying, I'm not going to ride Uber anymore. Well, and everyone is resorting to like Uber Pool. It's another product that they've introduced. And, we'll see what happens there, but that's going to the heart of the matter of what you're talking about there, Hari.
Well, and I think Wall Street will not be very forgiving if their revenue has to go down, right, in order to make their profits work, right? I like 2 years ago, I would use Uber, 2 or 3 times a month. I'm now down to maybe a couple of rides for the whole year, and they're usually for work, right, where I'm getting reimbursed for it, where I care less about the price. So I think it's in the same kind of situation here. WeWork has created a market for themselves that was never going to be sustainable, right? And rather than try and pull back or have investors say, "Why are you going?" They were kept funneling money into them, right? Mm-hmm. And so even though Adam Neumann is the poster child for this, the people who funded them are also, I think, owners of this business and are complicit in what's going on, right?
I agree. Yeah, I just want to mention one more. Yeah, on that point, yeah, I think I myself is also guilty of it. It's just classic, just scapegoating mechanism that a lot of us use, we humans. As Adam Neumann is an easy target, but the reality is, like you said, Hari, it's the entire cadre of people that made this possible for Adam Neumann for this, and I joke around with my coworkers, this absurd level of wealth transfer from SoftBank to Adam Neumann.
Yeah.
And then SoftBank or WeWork is just a front that Adam Neumann used, and the whole cadre of people involved, involving Adam Neumann, Masa, and everyone else involved in this. They themselves, the entirety of them, is to be blamed for this.
Well, and let's not forget, there are real people that are affected by this, right? Adam Neumann is getting almost $1 billion payout. Meanwhile, there are a lot of employees who worked for WeWork and who could have probably gotten jobs elsewhere, with their talent, are probably their options are now underwater, right? And that means that they won't be able to cash out options that they were given, in the idea that the IPO would would happen. They'd have a big payday, and then they would be able to cash in. A lot of that is not going to happen now, and I think I'm not too worked up about it because I think these people are getting paid a lot of money, and they can go get jobs elsewhere. You're not guaranteed these things in life, but the idea that Adam Neumann would make a profit off of this, where he didn't actually build a successful business, right? Is I think the terrible tragedy in this whole entire situation is that he owned so much of this company that in order to keep it around, Sun bought the rights to the business basically from him so that they could make this an ongoing concern. And what they should have done is just let it die, right? I mean, this business didn't have any it didn't belong, right? It was a failed experiment, and then it became too big to fail, and so you threw more bad money after good. Actually, more bad money after bad money, really here, and now you're seeing this thing implode. And frankly, I don't know how this is going to survive, even with this, this setup, right? They're saying they're going to slash their costs and all of this stuff. And it's like, it doesn't matter when the fundamental thing you're trying to sell is you're selling it at below cost, right?
Yep. Yeah, I agree with that. I think fundamentally, we talk a lot about as value investors, I think, we talk a lot about the fundamentals and why analyzing the fundamental and that the first part of the checklist is so important. And it goes to the heart of this matter, right? If you have to have a company that is able to protect its moat, have a moat to begin with, and be able to protect it, and all those things have to make sense. And you look at the business, and it just doesn't hold up to the test of our checklist. I think a couple minutes left before we have to call this an episode. What would you say what would be kind of the lessons learned from here as us retail value investors looking at this fiasco unfold? What are some of the key lessons that we can take away from this?
Yeah, I think any business that is IPOing with the intent of getting a payday for their early investors, right? Which is a lot of companies nowadays, right? You should be very wary of them, right? If the company is, because what we have seen is private valuations have skyrocketed lately, right? Look at Beyond Meat, right? Which is another good example. They IPO'd at $24 a share. They peaked at $240 a share. Wow. And now they're trading at like $80 a share after they dropped by like 20% in a day because of the lockup period, the 6-month lockup period expired, right? What I want to see is what Bill Gates did or what Jeff Bezos did is after 6 months, they didn't sell anything, right? If they're going to sell out, then they know there's something that they're telling you, which is, maybe they sell a little bit, but if they're dumping mass amounts of shares on the market, that's telling you that they don't even believe in the business themselves, right?
Yeah.
And that should be scary to you as an investor, right? Because the real money, most of these businesses, if they existed in the 90s and 2000s, would have been unprofitable businesses that IPO'd, but they said, we are on a growth trajectory and we're going to keep going on this trajectory for a few more years and then become profitable. And many of them did, Priceline and these kind of companies like that.
Yeah,
but
Amazon.
Amazon was, I think, marginally profitable even when they IPO'd. But what we don't see is we see VCs telling them, no, you need to keep growing revenue, keep growing eyeballs, keep growing these soft metrics that are not real, dollars, and keep growing them quickly, and we'll fund it. And then it gets to a point where it's too large for it to be to exist outside of, and they need a payday, so they dump it in the IPO, right? And so, as a rule, I don't invest in IPOs, period, right? For this reason, but you want some, operating history before you move to a company, to see a business as a publicly traded business.
Yeah.
And I think that's kind of the lesson that I take away from this is it's good validation that these IPOs are very dangerous, right? Because they're not run by people who are looking for their long-term interests. They're looking for people who want a payday.
Yeah, I would echo that. I would echo that 100%, Tari. The fact that people are wanting paydays and this kind of short-termism mindset about running businesses. I'm currently located in San Francisco and, in Silicon Valley area. And the sense I get living here is this. I feel like a lot of what's happening and the talks amongst people in the tech community is, it feels like Las Vegas. It's like a gambling area. It's like a gambling for techies. It's like legalized gambling that's in the orders of magnitude of billions of dollars. If you hit it big, and then you cash out, and that's it. That's the end of the story. There's no, that's the kind of sense I get. And of course there are diamonds in the rough, and you can find these needles in the haystack. But it is needle in the haystack. It is very, very difficult, in my opinion, to find these sorts of companies that are really looking for this precise vision of the future and pursuing that vision relentlessly and thinking about profitability as well. I think a lot of the sentiment here is that you build a company, you cash out in as short as 2 years, it could take up to 3 to 5 years, or even 7 years, and you cash out, and that's the end of the story. And that's success here.
Yeah. And I think as somebody who's seen this for a long time, I would say that if that's the mentality and your scoreboard is how much money you make, then you're never going to be satisfied, right? There's never going to be enough. There's never going to be I think there is a point where you have enough money to be comfortable and to be happy, right? And I know this is ironic coming from an investing, thing, but I think the best investors are the ones who enjoy the game, right? Which is looking for companies, reading about companies, finding the undervalued businesses, and then putting their money down. It's not so much that they have a ton of money. It's that they look for meaning in the actual work that they do, right? And what I see in a lot of people nowadays is they don't find any meaning in anything that they do. They just come to work because it's about the payday, right? And living a rock star lifestyle, which is devoid of anything, meaningful. And so you don't care about what business you build. You don't care about the employees that you have. You don't care about it at all. All you care about is enriching yourself, right? And we see this with Adam Neumann. I think he was a very good example of this, right? He the article that you referenced, he was actually trying to convert the NASDAQ and the NYSE cafeterias to be vegetarian, no plastic straws, all of this stuff. He was treating this as, if you want to do that on your personal time, fine, right? I may not agree with you. I like meat, but
yeah,
that's your decision to do on your own personal time, right? But then you hear about this guy harassing women. He was smoking pot in front of a pregnant woman, doing all of these things that are just, despicable things because, oh, I'm the king of the mountain, and, flying people into his Hamptons estate on the, company dime and stuff like that. I mean, that's the kind of stuff that's just disgusting, right? Like, as a person who does that kind of stuff is charismatic and has all of these things, but is completely devoid of any moral compass. And that is a thing that we should all avoid, right? Because when you see that in a business, what you will end up seeing is a company that will implode at some point, right? As opposed to, Under Armour was a great example of that, right? Culture at that company is just toxic, and you hear it and see it everywhere. And it doesn't. You can dig and find it pretty quickly. And the company imploded, right? Their stock price tanked, and all of these things happened because somebody turned on the lights and everybody was butt naked, right? So
I love these analogies.
Well, I'm just full of analogies. So I think the best thing that you can do is look for companies where they actually care about the business itself, and in order to care about the business, they have to care about things like profitability and other things. Because if they do that, then what you will see is a successful business at the end of the day. It may take longer, and it may be more painful, but it'll actually work. So
yeah, and those are going back to kind of lessons learned. Those are sort of the businesses that we should be looking after as value investors.
Yep.
And not to say that after saying things about, after characterizing kind of Silicon Valley as such, I do want to preface it by saying there are really solid people here. Of course, you can definitely find those, but I was just making comments about how my personal opinion of how I see things and kind of the general sentiment that I get. But I am sure that there are decent people who are striving for something greater than, quick payday for sure.
Yeah. And I think the last thing I'll say about this is that the environment that has been created there attracts people who are going to do this, right? Naturally, right? People who are seeing, how do I make a lot of money really quickly? It's going to attract that kind of person to come to an environment like that because they can see, right? See that
it's palatable.
It's much easier to do it there, right? If I'm trying to fleece someone and make money, it's a lot harder to do it in Omaha, Nebraska, right? Because there isn't a lot of VC money and there isn't a lot of people telling you, giving you hundreds of millions of dollars to do stuff, right? So
yeah,
it's just it's going to attract a certain amount of people who are just not. That's not their goal in life, right? So
yeah, and it may be just. I know we're going down kind of rabbit hole, but one more comment that I want to make here. It may be It may be we want our capital to be used in the most efficient way possible in an ideal scenario. Like a scientific experiment, you want in and out to be 100%. But the reality is, like combustion engines, you have these inefficiencies in the system. If you put in 100, you might get, maybe 20 out, 30 out. And so it might be just the inherent nature of capitalism where you have these inefficiencies in the system at play, and people can take advantage of that inefficiencies.
Yeah, I think the best thing to say about that is, in the capital market, in a capitalistic society, the only loss is private, right? And so Sun is the only one losing in this scenario, right? He's lost his, money, as opposed to this being a publicly bailed out company like GM was, which I don't agree with, right? It is far better to let private money be fail and people take risks than have governments decide who is a winner and a loser in certain scenarios,
marketplace.
In the marketplace. Yeah. And then that creates a bubble of things that is unsustainable, because the government isn't going to necessarily pick the most efficient business, right, or business idea. So anyway, I think we all know there are lots of companies that are coming out IPOing, and doing this, and in 3 to 5 years they may have enough operating history for you to go and look at them again. And I would really caution you at that point to decide what, is this company run well and has, is it run by the original founders? Is it run by people who care about actually making a long-term vision? Or is it run by people who are trying to get a payday, right? And I can tell you, you're not going to make a lot of money in investing in businesses that are trying to make a payday, the short-term versus long-term kind of scenario. So
yeah, a quick payday, long-term payday, like Bezos or someone like that. That's another story. Everyone wants payday, but it's just the time element of this.
Right.
That's important. Okay. Great. I think we talked plenty about this, and of course, more news is going to be hitting us about WeWork, I'm sure, in the next few weeks. So look for those in the Slack channel. We'll try to post interesting articles there. And if you want to sign up for our Slack community, please email us at info@valueinvestor.org, info@valueinvestor.org. And I did mention our checklist. If you want that as well, email us to the same address. Anything else, Hari?
No, I think you got it all. So
okay.
Thank you for listening, and we really appreciate your tuning in.
Yeah. Thanks a lot, guys. We'll see you on the next episode.
Yeah. Thanks.